Hey everyone, welcome to another explainer. So today I want you to basically think of me as your analyst older brother. We're getting the whiteboard out, we're rolling up our sleeves, and we are going to break down what's arguably one of the most misunderstood topics in investing. We are going to totally master relative valuation and market multiples. Let's get right into it.
Okay, I want to start off with a really classic trap. Take a look at this. A few years ago, TCS was trading at a price-to-earnings ratio, a PE, of about 30. Around the same time, Yes Bank was trading at a PE of 5. Now, if you're a beginner, you might look at that and think, whoa, Yes Bank is incredibly cheap. It's a steal. Well, no. That kind of thinking is actually completely wrong. Multiples do not directly tell you if a stock is cheap or expensive. A PE of 5 could definitely mean it's a bargain, sure, but it could also mean the company's earnings are literally about to collapse. Without context, multiples are a massive trap.
So today we are building your ultimate investor's toolkit. Here's our agenda. First, why valuation multiples matter. Second, equity versus enterprise value. Third, mastering the core multiples. Fourth, valuing banks, which is a very special case. Fifth, using multiples in practice. And finally, number 6, rookie mistakes to avoid.
All right, let's kick things off with Section 1, Why Valuation Multiples Matter.
So in the finance world, there are basically two ways to value a business. On one side, we have intrinsic valuation. Think of your classic discounted cash flow or DCF model. It's rigorous, it's mathematically sound, but man, it is incredibly time-consuming, and it relies on a ton of assumptions about the future. Now, on the other side, we have relative valuation, which is where we use multiples. This is quick, it reflects actual current market sentiment, and honestly, it's just much easier to communicate. While a DCF gives you this very specific absolute number, multiples are your reality check. Like, if your super complex DCF says a stock is worth 2,000 rupees, but the market price and all its competitors say it should be 500 rupees, well, something is probably off. The core philosophy here is super simple. Similar companies should trade at similar multiples.
Moving on to Section 2, Equity versus Enterprise Value.
Okay, so every multiple you'll ever see basically falls into one of two categories. First, you have equity multiples, like P/E or price to book. These are based on the market capitalization, so the price tag of just the equity part of the business. Then you have enterprise value multiples. These are based on EV, which looks at the price tag of the entire business, debt included. And here is the major problem with equity multiples. They can be wildly distorted by how much debt a company carries. If you have two completely identical businesses, but one is drowning in debt and the other is totally debt-free, comparing their equity multiples is going to totally mislead you. Enterprise value, on the other hand, gives you a metric that is completely neutral to the capital structure. It lets you use powerful tools like EV to EBITDA or EV to sales if you're looking at, say, high-growth tech companies that aren't even profitable yet.
Let's actually make this concrete and calculate the enterprise value for Reliance. First, you take the market cap. That's what the stock market says the equity is currently worth. Let's say 19 lakh crore rupees. Then you have to step into the shoes of someone buying the entire company lock, stock, and barrel. If you buy it, you have to take on their debt, right? So we add 3,30,000 crore. But hey, you also get to keep all the cash sitting in their bank account, so we get to subtract 2 lakh crore in cash. And that gives us our true enterprise value, 20,30,000 crore rupees. This number right here is the true debt-neutral price tag of the entire operation.
All right, let's get into Section 3, Mastering the Core Multiples.
First up is obviously the most famous metric of them all, the price-to-earnings ratio, PE. It's just market cap divided by net profit. But what is it actually telling us? Well, as valuation expert Aswath Thamodaran points out, the PE ratio reflects the market's expectation of three things: growth, risk, and quality. A really high PE means the market is willingly paying a massive premium because they expect crazy high growth or phenomenal, consistent quality. And like we talked about earlier, a low PE isn't a guaranteed bargain. It can actually be a giant flashing warning sign.
Now, what's really interesting about this is seeing how it actually plays out in the Indian market. Just look at Nestle India trading at a PE of around 85. Does that mean it's 14 times more expensive than Tata Steel sitting down there at a PE of 6? No, of course not. Nestle commands that huge premium because of its incredibly high growth and quality. TCS sits comfortably at 30 because of its remarkably consistent earnings. And Tata Steel at 6? That right there is a classic cyclical trap. If a massive steel company has a PE of 6, it usually means its earnings are temporarily at their absolute peak, and the market knows full well those earnings are about to drop. You just cannot compare a steady FMCG giant to a highly cyclical steel manufacturer. Next up, we have the absolute workhorse of the professional analyst, EV to EBITDA. That's enterprise value divided by earnings before interest,
tax, depreciation, and amortization. And there's a reason this is Aswath Damodaran's favorite multiple. By using enterprise value, it totally ignores how a company is funded. By ignoring taxes, it strips out annoying jurisdictional noise. And by ignoring depreciation, it smooths out all those different weird accounting policies. It essentially gives us a beautiful, pure look at a company's operating profitability. That makes it absolutely incredible for cross-border comparisons or for valuing heavy manufacturing businesses.
But as your older brother in finance, I have to give you a bit of a reality check here. You can never, ever look at EV to EBITDA without also looking at actual capital expenditure. Warren Buffett and the late Charlie Munger famously had a great quote about this. They said, "References to EBITDA make us shudder. Does management think the tooth fairy pays for capital expenditures?" It's so true. EBITDA is a great tool, but it is not cash flow. If a company has massive, ongoing maintenance costs to keep its factories running, EBITDA will completely hide that. So always check the cash flow statement too.
Okay, moving to Section 4, Valuing Banks, which is a very special case.
So, for normal companies, debt is a source of capital, right? You borrow money to build a factory. But for banks, debt is literally their raw material. They take your deposits, which is debt for them, and they manufacture loans out of it. Because of this dynamic, trying to calculate enterprise value for a bank is just mathematically meaningless. Throw it out the window. Instead, the ultimate metrics for financial firms are the price-to-book ratio, or P/B, and return on equity, or ROE. See, a bank's book value is essentially its regulatory capital base. And because a bank's assets, like loans and securities, are constantly marked to market, that book value is actually a highly reliable anchor to base your valuation on.
So the crucial point here is how price-to-book and return on equity interact with each other. Look at this comparison. HDFC Bank and ICICI Bank both generate returns on equity right around that 17 to 18% mark. And the market rewards that high profitability with price-to-book multiples around 3. Now look at SBI. Its ROE is a very healthy 16%, so almost as good as HDFC. Yet its price-to-book is just 1.7. Why the massive gap? Well, that's the PSU discount. The market is actively pricing in the risk of government interference. Even with really similar returns, the market simply will not pay the same multiple if the underlying risks are fundamentally different.
And this scatter plot right here brilliantly illustrates that exact relationship. Notice the price-to-book ratios on the vertical axes against the return on equity on the horizontal axes for a whole basket of banks. Look at that clear upward-sloping trend line. There is an undeniable structural order to this chaos. Banks that generate higher returns on their equity are mathematically rewarded with higher price-to-book multiples. It's a nearly perfect correlation. So if you're analyzing banks and you find one with a really high ROE but a surprisingly low price-to-book ratio sitting way below this line, well, you might have just found a massively undervalued gem. Or, a bank hiding a bunch of toxic assets. But either way, it tells you exactly where to look.
All right, let's get practical. Section 5. Using multiples in practice.
Okay, so here's your 5-step professional framework for actually using these tools. First, you need to identify a very strict peer group. We're talking same industry, similar size, similar growth profiles. Second, pull their multiples, but please don't just look at today's numbers. Pull the 5-year average so you smooth out any weird anomaly years. Third, compare your target stock to that peer median. Fourth, you have to justify the gap. If your stock is trading at a premium, why? Does it have better management, higher growth margins? If you literally can't justify the premium, it's probably overvalued. And fifth, check the historical context. Remember, multiples compress significantly during market crashes, and they expand wildly during bull runs. Mean reversion is essentially gravity in the stock market. What goes way up eventually comes back to the average.
Which brings us to our final section, Section 6, Rookie Mistakes to Avoid.
Okay, Protective Analyst Older Brother mode is fully activated right now. We are going to rapid fire through the most common ways I see amateurs lose their shirts by misusing multiples. Please do not make these mistakes. Number 1, thinking a PE under 10 always means cheap. Honestly, it often just means the business is dying. 2, assuming a PE over 30 is always too expensive. High-quality, fast-growing companies actually deserve a premium. 3, comparing IT multiples to bank multiples. Totally meaningless. They are operating in completely different universes. 4, relying on a single year's earnings. Like I said, always use a 5-year average to be safe. 5, ignoring growth entirely. A PE of 20 is dirt cheap if the company is growing at 40% a year, but it is wildly expensive if they're only growing at 2%. And finally, the deadliest sin of all. using PE to value a cyclical stock, like steel or commodities, at the absolute peak of its economic cycle. That is a guaranteed way to lose money.
Look, if you take away absolutely nothing else from this explainer, let it be this one thing. Multiples are not absolute truths. They are relative benchmarks, and they require deep, deep context. You must always compare within the exact same industry. You should rely heavily on enterprise value metrics, like EV to EBITDA or EV to sales for your high-growth tech stuff, to neutralize those sneaky debt distortions. And when you are analyzing banks, throw all of that out and pivot entirely to price to book and ROE.
Which leaves us with one final kind of dangerous question to think about. You now know exactly how to compare Reliance to Tata or HDFC to SBI, right? You can find the absolute cheapest stock in any given sector. But what do you do when a massive bull run has made the entire market, literally every single sector, completely overvalued? Relative valuation can't really save you there. The only way to answer that is to build an intrinsic DCF model from scratch. And honestly, that is exactly what we are going to master in our next explainer. Thanks so much for joining me today, guys. Keep studying, and I'll see you in the next one.